Yes. Perfect.
Brock, thank you. It's great to be back, and hello everyone. Good to sort of remotely, I guess, virtually meet. I'm gonna put down my Zoom thing so I can just see. So let's try to. So in this, when I'm going through this, try to imagine that you want to apply this to your company, and if there are specific questions that you have, then just raise your hand, and then just kind of someone can maybe moderate and ask them throughout. I'm perfectly okay with that, and I'd like to make it a little bit interactive, so so please feel free to do that. Most of the things here, sort of how VCs operate, what they're looking for, kind of kind of timeline of fundraising, valuations, kind of materials you need to prepare, all of this stuff we'll touch on. It's quite a broad, of course, introduction, so it's limited to the kind of depth we can go into on each. And I'm sure that each of these topics could have their individual presentations. So it will be more high level, and more than happy to follow up with people afterwards in direct meetings. If it's interesting to somehow support a bit on anyone's fundraising. So that actually segues me pretty nicely into what is probably a nice start here, which is an introduction of myself. So as Brock said, my name is Magnus Gaarder. I've spent the last 13 years abroad outside of Norway, Oslo, where I'm born. And I've focused, initially, well, I actually started studying and finished a study in computer science and machine learning, but started working in finance in 2008 in New York in investment banking. So having sort of done M&A there for a while, relocated to London after about 6 years in the States, where I was part of, I guess, a small team that had just started a new investment bank called Portico Capital, or at least the European arm of this bank. And we were selling B2B SaaS companies into private equity. They're doing really well today as well, so excited for them. I jumped into VC, joined a fund called Nauta Capital. And Nauta is one of the leading B2B SaaS VC funds in Europe, and it's through Nauta that I learned a lot of the ins and outs of this space. And I should say that I had I guess made a lot of close friends in the VC space in those years, and that's where a lot of the deal flow and so on we have today come from. I split out from Nauta to start nFront Ventures, and at nFront we have a bit of a different approach. So I should just quickly say this before I start diving in. Generally in the VC market in Europe, it's incredibly fragmented. There are hundreds of different funds out there, and it's really hard to fundraise. Everyone is spending kind of 6 to 12 months breaking their back trying to do it. Who do they speak to? How do I close them? What's the best investors for me in terms of strategic value add? All of that was really difficult. So in fact, what we do is we actually dive into 3 to 4 companies per year. We superpower their entire fundraising process from start to end, including preparatory work, all diligence work, all introductions to the right VCs, and all of that. And when the round goes through, we co-invest alongside 1 or 2 leading VCs that we help bring in. So that's our model, and this is also why we know quite a lot about fundraising. It's what we do professionally. So happy to speak more in depth about these topics at a different occasion. But that brings me into, I guess, the presentation. So first thing I'd like to talk about here is the venture capital life cycle. So sort of just a high level overview of how VCs operate. As you probably guessed, it starts with the sourcing phase. And in sourcing, it's typical that the more junior staff, analysts, associates, etc., spend a lot of time scouring the market for the best and most interesting companies. Now we're going to go into detail later about what they're looking for, but it's typical that a VC fund looks at something like 2,000 to 3,000 companies per year if it's quite a broad geographic mandate. And so it's of course a lot of these introduction meetings, but it never means that is a guaranteed investment just because they're interested in the beginning, and there's a lot of companies they're reviewing. So don't kind of go out to a lot of VCs when you do this. Keep in mind that you probably have to, it's a bit of a numbers game, it's a bit of luck involved, so you probably have to hit quite a lot of funds before you get a good set of term sheets on the table. Don't hit them all at the same time, because that's obviously spamming the market. It's bad for psychology, but there are ways to do this that we'll get into later. Then we're coming into this due diligence phase. And this is kind of like a funnel, right? Because you start sourcing all these companies. Of course, you don't go into depth in 2,000 companies. But in diligence, what typically happens is, kind of 3 to 4 months at least of deeper research into a few of the businesses that you think are interesting. And this is after the management meeting has been held. So here, the VC is trying to look at, the barriers to entry, the growth, the margins, the competitive landscape, all the different things they need to understand and realize in order to decide whether they want to invest in you. We'll come into later in detail what they're actually looking for. Then comes the happy moment. There's an investment and you get finally some cash on your balance sheet. This is when the real work actually starts, when you will be working together with the VC1 to build your business. Now, a bit of insight about VC funds and how they work. VC funds typically have a 10-year-long fund cycle where the first 5 years are spent on making investments, and the last 5 years, called the divestment period, is spent on exiting investments. So keep in mind that all these VCs are very concerned about how are they going to get an exit from your company. And now it's harder than ever to get an exit. In the beginning, when I started in VC, maybe average holding periods were 3 to 4 years. Now holding periods are 5 to 7 years. So it's really tough in this day and age to actually get an exit. So they're really focused on this, and just keep that in mind because maybe you don't have the same plan of an exit as the VC has, and it's important to understand how different stakeholders think about your business's future. Another thing that's getting more and more relevant, strategic M&A. There's so many different companies with the same kind of product operating in similar markets, just in different geographies. And I think we're moving into a day and age of consolidations, probably, where more and more of these companies are going to be put together. And I have my own thoughts about this and how that could be exciting. But I think this is something that makes sense for some businesses. And I think we're probably moving into the next 5 to 10 years where there's going to be more of this. Pre-exits, sort of just preparations of getting acquired or having an IPO. Now, when it comes to an actual acquisition, it's either financial buyers like secondary funds, or it could be it could be larger PE funds or whatnot, or it could be a strategic acquirer like another technology company. And in fact, 70% or something of the exits last year were actually by sort of strategic acquirers, in fact. So that's by far the biggest one. We are actually, though, seeing an increase in secondary funds, which is really interesting. And this is great because remember how we said that it takes longer and longer to exit. Secondary funds could be an awesome way for VCs to sort of get their exit within their 4 or 5 years, and then for founders, etc., to get a little bit of a cash payout there, but to continue the journey for many years until the company is a lot bigger. So I'm quite excited about that trend. So that's the overall life cycle. Moving into sourcing. And as I'm talking about this again, have a think about how this applies to how you are actually meeting VCs. And the first thing I want to mention is inbounds. So quite often, VCs are getting direct outreaches from entrepreneurs. What I want to say here is don't be afraid of reaching out directly to VCs. It's not like you can't send a cold email. Just make sure you educate yourself so you don't waste your own time and their time about what's the geography, stage, and sectors that the VC fund is focusing on, so you target the right VC funds. There are over 500 different individual VC funds in Europe, and there's a lot of CVCs and VCTs as well, corporate venture capital funds and venture capital trusts. So, it's good to do your research first and make sure that your outreach fits with who you contact. Another good way to meet VCs is in events like this. Also, Slush is great in the Nordics. You have Web Summit, you have TechCrunch Disrupt. There's a whole bunch of different events that might be useful. But if I were you, events take a lot of time. Focus on a handful of events per year and don't scatter yourself out on all other events. It's more important that you grow your business than that you are kind of an event goer, so to say. At events, you also get to know investors a little bit outside of regular business. Going out, having a few drinks, getting to know people as friends is also a great way to create connections. And in the end, that's what's going to make all the difference. if you can get an actual introduction from either another entrepreneur, one of your advisors, another investor that you already have, that's great. Take advantage of that. You could also work with someone like us who professionally work on this. We, as I said, both invest and do the whole fundraising process. So in those regards, we have strong investor relationships, over 400 funds in Europe, and we would be happy to help the right companies with those things. Finally, we also have relationships to universities, and VCs like to source early stage companies from there if they're focused on typically the seed stage. These are very young companies, of course, that take a long time to evolve. And actually, one of the best investments we had out of Nauta was a e-voting platform that came from university. Took almost, I think, 10 or 12 years for it to reach exit. But it was a very successful outcome, I think, for Nauta. I wasn't involved in it, I should say, as a disclaimer. But just an example of how long it could take to build good companies. It's very tedious and time consuming. And that's where the VC is constantly feeling the pressure for having to find the good exit for companies they invest in. And finally, even the top VCs have a small team that sit and look for companies outbound wise. So public databases, private databases, online screening, events, event lists, and so on and so forth. So you might have the case where VCs reach out to you, want to get in touch with you. Take the meetings if you're ready. And it's always good to create these relationships early, right? So you can hit the ground running when you're actually planning to fundraise. It's never smart to start your fundraising exactly 12 months before you need the money. Then you're in a very bad position, both in terms of your own business, but also in terms of negotiation leverage with the VC itself. Okay, investment characteristics. So this slide will talk a little bit about, sort of what are VCs looking for, and sort of how should you think about. We have another slide later in this deck about sort of the pitch, your pitch deck and so on. I'm not going to spend a lot of time on that slide. I just wanted to show it to you. You can think about this slide and that slide as a little bit overlapping, because we're here talking about what should you emphasize when you're talking to VCs, what's important to them, and understanding how they're thinking is going to help you when you're trying to convince them that you're the right company to invest in. So that's the goal of this. So team is the first piece, right? And this is becoming a bit of a cliche, of course, over all the years. Everyone's talking about the team, the best team, and so on, and that's what they invest in. So that doesn't necessarily mean serial entrepreneurs. You have a lot of new entrepreneurs that are really strong. So how do you evaluate this, right? Well, it's actually a little bit difficult, but I would guess a combination of sort of drive, ability to attract the right kind of people around yourself to build a strong team that's complementary to yourself, integrity, domain expertise in the area that you're addressing with your product. Sort of why should you be the team that could crack a solution to this problem that everyone else has been trying to solve before? They just want to understand that you can build strong teams and that you have strong domain expertise, and that you are the person that can take and build $1 billion business out of the idea that you're pitching to them, for this early stage company that you're pitching. So it's more of a, this is really more of a, it's a bit of an art, and it's a lot of chemistry. Keep in mind, this goes both ways, by the way. You need to like the investors that you're going to get an investment from, because obviously, you're going to be working closely with them for the next few years. It's a long marriage, so make sure that chemistry is mutual. We talked about this before, but please educate yourself sort of on the stage, the sector, and the geography that the funds you are planning to reach out to focus on. It's obviously the case that different funds have very different focus areas, and that is important both for your ability to close an investment, but also for their ability to add value to your company. So it might be a whole bunch of firms that focus on exactly your stage and your tech, but finding the ones that can really add value to your business is going to help you a lot in the long term. And this is also something that we are very focused on when we're working with our companies, finding the best possible investors. A poll popped up here. I'm going to close that. So moving into, I lost focus. Here we go. Moving into the next piece here is disruption. So disruption is like a cliche word, right? But you have to show some ability to change some kind of factor or some kind of market or some kind of process that has yet to see, properly disruption by technology to date. An example is an investment we made in a company many years ago called BMI, which completely changes the entire market research space by having individual people like you and I running around doing market research with their phone and getting thousands of different data points within a fraction of time of what Nielsen or the likes could do. Another example is a business we actually did a fundraise for in earlier this year, which is called Shada, which are changing completely the way consumer-to-consumer logistics is done with a very cool marketplace where you can buy and sell secondhand goods. So, you just have to convince investors that you're having a proper impact on a particular problem. And that's why in your deck, you start with a problem and your solution. Here, you have to create a feeling in the investor's gut that there's a strong need for what you have built. Because the one reason for why startups fail is because there wasn't a big enough need for what was developed. So the need there, make sure they really, really grasp that piece. Growth. Here's another thing that I find that startups don't always think about. It's the VC knows that 70% or whatever of their portfolio, it's like this 80-20 rule, right? A lot of the portfolio is going to go not so well. Some are going to go decently well. And a very few companies are going to do very well. So what does this mean for you as founders? It means that you have to pitch your startup to the VC in a way that he believes or she believes that your company is going to be the one business that's going to return their entire fund. They have to see that kind of $500 to $1 billion EV potential, enterprise value potential. Otherwise, they will not want to invest. So showing and maintaining strong growth from one fundraising to the next is absolutely critical. And that's a challenge for many people in Corona, right? That they haven't been able to continue that growth rate. But also in your forecast, making sure that it's believable, tying in historic forecast to future forecast, making sure historic numbers to future forecast, making sure that it shows that within 7-8 years you can build that unicorn company. Without it, very few VCs will be interested. Another thing that they focus on is barriers to entry. How do you show that what you built is very difficult for someone else to copy? Do you have a strong IP? Do you have patents? Do you have a brand name that people recognize? Do you have customer relationships? What do you have that makes it difficult to replicate? And on the same note, very important piece is the competitive landscape. You have to show, and this you can't just say, we're focused on slightly different size of market, SMEs instead of bigger company. Like that could be a small thing, but keep in mind you have to show on like a feature level and convince them, why are you going to become the market leader in Europe? How are you going to beat the companies in the US? If you can't show this kind of and create a strong conviction that you're going to be the winner in this market, it's hard to convince VCs. And here I want to stop for a second and say that VCs isn't the only path to growing, right? You could build, rock by rock and stone by stone, a very strong company that never really needed VC funding. So maybe your business isn't that kind of hyperscale, hyper growth case that needs millions of dollars to grow. And that's perfectly fine. There's nothing wrong with it. And there's a lot of strong businesses that have been built without VC money. So just keep that in mind. Even if your business isn't a typical VC business, doesn't mean it's a bad business. Timing wise, you have to make sure that there's a need. We talked about that. Timing could be that your product is ready to be launched, so there isn't a whole bunch of bugs when you launch, and that the market itself is ready for your product. We have seen IoT, for instance, which have been around forever, and it's never really broken through at a big scale in the consumer market. We have seen, a lot of other things that's taken a lot longer, like no code, for instance, which is really popular today. It's something that has been around since, for God knows, 40 years or something. And it's never really taken off. So timing is very important for VCs, and convincing them that now is the right time for your company to be successful in your type of product, that is important. moving towards the end there, sustainability is not just about, what everyone's talking about today. It's and social and environmental sustainability. What I'm talking about here is also financial sustainability. What kind of business model do you have? Recurring revenue, which has a lot of visibility on the revenues going forward, and convincing with your current pipeline the investors that your forecasts is really going to happen by showing that you have a sustainable and proven monetization strategy is very important. So keep your focus on unit economics and make sure you can convince them of this. Scalability ties into the growth piece. It ties into your margins. How much is it going to cost for a VC to help build this billion-dollar business, which ties into the last point around capital efficiency. How much have you raised to get to where you are today? Which the VCs will use as a proxy to think about how much do you need to get to the next stage. And therefore, it usually isn't seen as a positive thing that you spend so much money and so much time building all this amazing technology if you don't have any traction to show for it. Capital efficiency is something a lot of VCs are looking for, and it's an important thing you should keep in mind as part of your story when you're pitching to the VCs. Yes, so that is a high-level overview. We aren't going to don't get scared from this. This is probably something that could be, kind of this. By the way, can be seen. I'm going to maybe post something on the chat if that's possible. Is there a chat in here? Yeah, there we go. Let's have a look. One thing I wanted to do. I'm going to just post a link on that. So I just posted a link. Oh, sorry, I just see the points here. Can you make it sound a little bit clearer? I will try to slow down a bit. There's a lot of stuff to cover, so that's why it's going a little bit fast. But I'll try to be clear. The link I just posted here on the chat is a collection of research, so sort of like all the European VC rounds, most of them put together, which actually shows you what do you need to have in terms of metrics to fit at different kind of fundraising stages. This is a very common question we often get. What do I need to raise this and this type of seed round? What do I need to raise this and this type of Series A? And so here we actually have quite a strong set of data on this particular topic. If there's hands that are being raised, I can happy to answer anything about this. Barak, just let me know. This is typically something that I think is a question mark from a lot of entrepreneurs, and in fact a lot of the companies we speak to have a bad idea about I think have a really kind of wrong idea about what they need to have in terms of getting a certain valuation. So asking a way too high valuation for where they are metric wise. And that's something we come across quite often, and it takes a little bit of explaining that if you're going to have a round that is somewhere from, kind of 10 million plus in pre-money valuation, you need to have, around probably 700K plus in ARR, and you need to be growing quite fast, and you need to have a strong CAC to LTV ratio, and there's a bunch of other things that you need to show. So, and again, different revenue models are not deemed equally. A recurring revenue model is valued much higher by most B2B SaaS investors than a one-off model. So all of these things will affect your valuation. So this you can come back to later. I will not talk through all of it, but it's interesting to see that the research that's out there. Just again here. There we go. Okay, so again, not going to read through this in detail, but keep in mind that it's also up to you, right, to determine, do you like the investors that you're talking to, and do you think they can add a lot of value? Again, as I said, one thing we're really focusing on for our startups is to find the best possible co-investors that can add a lot of value to your company in addition to capital. So how can they pull in new strong talent, recruiting, right? How can they open doors to new potential customers that you need in your space? How can they add value to making your operations more streamlined and efficient? How can they bring in new investors in the future? What kind of experience do they have in international expansion? So all of this stuff is important, and keep in mind that you want this value from your investors and not just the money. Okay, so again, a high level thing. So we're covering a lot of topics here, but I just want to mention this about boards. If you're building your board, typically in the pre-seed stage, it's normal that your two co-founders, you're both on the board, right? And again, startups don't really have as much this separation of concerns that we often see in bigger companies, where management should be different from the board members, should be different from the shareholders. That's the core concept of a board and separation of concerns, but doesn't really apply to very early stage companies. So you have co-founders, both are on the board. Then you get some kind of angel seed round where they step in as the third board member, which is quite normal. And then here's the key point of this slide. Just keep in mind when you're putting together your Series A that typically the VC will be the fourth board member, and they will typically suggest that they can implement an independent, or there should be an independent fifth member. Now, if the VC chooses who this independent member is, this is an investor-leaning board with two co-founders, two people that are members of the company, and three that are actually, kind of on the team with the investor, so to say. So just keep in mind when you're putting this together that you're not positioning yourself out of control of your own company. So this is a very important decision to make, and that independent party should be properly independent, or even someone you choose. You should try to push for that at least. So that's the important part to take away from this slide. We spoke a bit about this before, so I'm not going to go through details, but your investor presentation should start with a bit of a summary of your traction and why it's interesting. Start on something like that, because you only get a few minutes in the beginning to really capture the investor's attention, and you want to make sure that they don't. Let me close this. You want to make sure that they really they get this feeling of, oh, this is super interesting already in the first couple of slides. Otherwise, they're going to lose interest and not going to be able to pull them back in. One actually thing I see, just as a takeaway here, that a lot of entrepreneurs is doing, which is a huge mistake, is that you have to take all the complex information you have in your head about your product and the tech and the future, and you have to create it into a very crisp and clear and simple explanation that anyone could understand. You cannot assume that the investor has in-depth knowledge in your space, and you have to kind of like treat them in the beginning as someone that's coming in blank. So you want this to be very understandable and very quick for them to see, oh, this is interesting, and there's a clear need, and this company has an amazing solution. So start with the executive summary about your traction, explaining the simple problem, stating your solution, and then kind of touching on how big is the market. Again, this is going back to this growth and how big you can get. Coming into the clear differentiation, why are you the one to win here? How are you different from the competitors? You cannot get away with a simple explanation to this. You have to really make it convincing. Finally, getting into unit economics and the kind of the revenue model, then showing an overview of your customers, and kind of here it's very powerful to have some quotes and kind of show how much your customers love your product and how low your amazing churn is. It's all good to mention here. Coming into some financials, some forecast historics if you have that. Going into how big the race is. Finally, kind of exit considerations and why this is the right timing. And you can end on the note with the same kind of summary of the interesting terms. Would be a good structure. This is just what I recommend, but it's always up to on a case-by-case basis what makes sense. But these are some important parts to include. I'm not going to spend time on this. VCs have different exit strategies. Technology exits, stage exits, takeouts, long game, etc. Most funds aim on this long game, and we talked a little bit about before how long they're typically sitting in a particular investment. Towards the end here, I think we actually made it through most of the stuff. It's just an overview of the UK seed and venture capital landscape. Just some ideas for you for fundraising. We personally have over 400 VC relationships in Europe, and we're happy to take a look at your business to see if we can help up anyway. But these are just some of the players in the UK. Yeah, and I think that actually takes us through the high-level overview, sort of at the 35th minute here. Please, reach out, add me to LinkedIn, to Twitter, and appreciate the time. And should we maybe move into a few questions and make it a bit interactive, bro?
That will be great. So we have the first question. Any tips on keeping the control? I mean, I think Yuan mentioned that you have already mentioned in your slides about the board and also the structures of the startups. So do you have any tips on keeping the control of the startup?
Yeah, so of course, the first tip is to make sure that when you negotiate the contract that you're not giving away too much of your business at a too early point in time. Every single VC round is typically anywhere from 15% to 25% of your company. So the pre-seed round is typically 10 to 15%, or even a little bit more. Then the seed and Series A round is typically 20 to 25% of your company. Keep us a rule of thumb. After you raise your Series A, you and the founding team should have about 40% of your company left. So that's important, of course, in terms of the share you keep. And this is actually something we spend quite a lot of time on with our startups, is sort of making sure we advise them properly on the terms in the term sheet. Because one thing is the valuation you get and so on, but there could be quite a lot of other terms in there that are not related directly to valuation, but has to do with liquidity preferences, for instance. In an exit scenario, who gets money first? In a down round, who can invest at what kind of valuation? And there's often these, or sometimes there's these anti-dilution clauses, which gives the current investors the right to invest more at a much lower valuation if there's a down round. So there's a whole bunch of these different terms and clauses that is important to think about. So one thing is board, and we talked about that, but another thing is the term sheets, and that's where I would keep a lot of focus and educate yourself a lot beforehand.
All right, and the second question is about the pitch deck. It is very important to make a presentation, proper presentation. Ayush Bansal asks, how many slides should we keep in the deck? What is the maximum numbers for a seed round? And I should also clarify more about these questions. It all depends, of course. I'm going to share the questions to you, Magnus. It all depends. I think the 2 minutes pitches and an hour-long pitches. So should you also describe kind of different types of presentations?
Yeah. So first of all, the regular management presentation with a VC, it's either 1 hour or 1.5 hours long. So when you rehearse this, you should be able to deliver the whole presentation within sort of 45 minutes. And personally, and people might disagree, I prefer when companies go through a deck and it's very clear and organized. Sometimes if founders feel like, oh yeah, we should just talk about it loosely, it's very hard to know what do the investors know from before, and how do you keep really emphasis on the most interesting points of your business. Keep in mind, this is so important, these meetings you have, so you should have rehearsed it 100 times, and you should know exactly what to say, when to say it, how to say it. And in my opinion, that is much better delivered with a proper deck. I think, in terms of pages, hard to say, but 10 to 25 pages, something like that. You can put a lot of the non-interesting stuff that's not on this slide here in the appendix. That's perfectly fine. But the important things you should have in the main presentation. The most important thing is, two most important things is, keep it clear and concise so that it's easy to understand, and your solution, why it's needed, is very clear, and why you are the person to win this market is very clear. And secondly, that you capture their attention early on. It should never be the case that you speak about your company for 4 or 5 slides and the investor has no clue what your product is. That is like a terrible thing, and I've seen it happen many times. So I would just say that on that topic.
So do you also recommend the entrepreneurs to memorize all the script, or should they do authentic kinds of pitching?
So this varies from person to person. I am a huge favor of luck favors the prepared. So the more prepared you are, the better it's going to go, and the more luck you're going to have. Quotation. I typically use the Frank Sinatra analogy on this. So Frank Sinatra has been known as one of the most entertaining and most proficient stage men in history. He was equally good at sort of practical jokes and commentary on stage as he was singing. All of this sounded very intuitive and natural when it came from him. Frank Sinatra is also the most, perfectionist rehearser probably in history. He practiced every single thing he was going to say to excruciating detail, to the point where he could make it sound, he knew it so well that he could make it sound 100% natural. And that's typically my approach as well. If it's something very important, make sure you practice it so well that you know exactly how to deliver it, exactly what to emphasize, and know it so well that it doesn't sound rehearsed, that it sounds completely natural. And that is the power of proper preparation, in my opinion.
Like we did when I asked you the question and you answered the answer. All right. It was very authentic. All right. Three things to identify when you look at a startup on a seed stage. Alex has asked this question. I mean, he probably mentions that, what the VCs look, the three things. So as you're a GP, what are the common three things that you look in the seed stage?
Yeah. So at the seed stage, can I ask a clarifying question? Is this pre or post revenue?
Let's say pre-revenue.
Pre-revenue. Okay, so keep in mind a lot of seed companies have breached into revenue and early traction. So I typically call that pre-seed or pre-revenue. So when it comes to pre-revenue, it's of course a lot harder. And in fact, personally, I think it's very difficult to evaluate, particularly B2C companies that are pre-revenue. So it's something that we're generally a bit careful about. But what I'd like to focus on then is sort of the knowledge and experience of the team. So coming back to this first piece gets very important. And their ability to convey to me why their solution is going to be the one solution that's going to take this market by storm. And I'd also very much like to see some early proof points, kind of maybe a pipeline of potential companies that your customers that you're reaching out to that have indicated that when this is live, they definitely want this. It could be so useful to them to show some of that pipeline traction even early on, even though they're not paying customers at this point in time. Just create. The one thing you need to focus on here is competitive differentiation and why there's a big need. I think is really the core things to convince the investors about.
And also, Abdullah has a follow-up question. I mean, directly not related, but how to evaluate how much equity to be given to a VC in investors in general?
Yeah, so that's quite standard. As I said, sort of seed rounds typically see 10 to 18%, between 10 and 18. Whereas in seed and Series A stages, it's typically 20, around the 20% mark that you give away. This is market standard. And in my opinion, it doesn't make sense to go out to VCs and say, this is my valuation, this is what I want. Forget about it. Like, they know this market well, they know what the other valuations are going for. And if they ask you what you think the valuation should be, it's only to see if they are going to be interested at all to have a conversation with you, or if your idea about what your business is worth is completely off the mark. Because then there's no point in having a discussion if they They don't think you understand what a company at your stage is going for. Where it is not so clear is when you're talking to angel investors and high net worths. That can go in both directions. So we have quite a lot of these high net worth relationships where we, tend to share interesting early stage companies that maybe are right at launch. Maybe companies raising from somewhere from 1 million to 1.5 million, and they're just launching. And in these cases, valuation could go in both directions, right? It could be like because these people they're often billionaires. They've earned a lot of money on their own, and they can be very they're smart with how they invest their money. So they could suddenly say, yeah, I'll take it, but half valuation. Something like that can be thrown out in a meeting right away, and you get caught off guard, and maybe you have to go back and you of course you think about it, and maybe you take it or maybe you don't. But when you're talking to high net worth and angels, you can dictate the valuation a little bit more, but that can fall in both directions very much, and it varies much more from like a norm. There is no norm, whereas in the VC there's very much a norm.
All right. And is it better to get investment in early stages or to wait for a good traction and start investment rounds?
Yeah, so the answer to that question is you should raise the right amount of capital at the right time. So what does that really mean? Well, it means that, typically, the rule is the longer you can bootstrap the company without damaging your own growth, the better. Because capital efficiency is a key thing that the investors look at. So if you can get to about €1 million in revenues with about €1 million or 1.5 million euros raised, that's fantastic. That's a really strong capital efficiency. Of course, many companies don't have that kind of capital efficiency, but it's just an example of strong capital efficiency. Mm-hmm. Now, I would say, what do you raise at what time? So at sort of the normal way of this is to raise somewhere from 200 to 700K right when you're at that, I guess, that MVP. You've started getting a little bit of early interest and you just want to push it a little bit. You raise maybe north of $1 million. But I've been part of rounds, like we've done 2 rounds last year for about €1 million where they were just launching. So there's no direct answer to this, but somewhere between 600K to 1.1, 1.2 million makes sense for a company that's just in launch phase. Then when you started showing 50K plus in MRR, then you can start thinking about 2 to 6 million euros. But if you're going up towards 4, 5, 6, you should probably be around the 1 million euro mark in ARR.
Magnus, I think it also depends on the geography as well. I mean, sometimes, purchasing power parity or the revenues are different in country to country. I think you are mentioning about UK startups, right?
Yeah, you're very right. Thank you for clarifying that. That's absolutely right, Parag. So in the US, the numbers are much bigger than I said. And in certain non-hub regions, it's maybe smaller than what I'm talking about. But this is generally if you as a company in a non-hub VC region, so not in the UK, not in Germany, and you want to raise capital from these international funds, which is in fact what we try to spend a lot of our time on, finding those interesting companies in non-hub regions and helping bridge the gap into international VC, then it's typically those levels that we're looking at.
Also, there are questions about the pandemic and this environment, these situations. Gurmesh has asked, what do you think about the travel and events for now? Do you think that it is a wrong time to raise money and to get right valuation, even though it's a tech platform?
So the travel and kind of hospitality focused VCs are struggling. They are, of course, licking their wounds, trying to help their current portfolio companies survive. Many of them probably won't be raising funds again. So those VCs that are focused only on those spaces are in a bit of a hard spot right now. But that doesn't mean that you can't raise from funds that are generally focused on B2B SaaS or even B2C, if that's the travel segment that you're in. But I do think it's a bit harder for those companies right now. You have to find some way to show that you still have traction there are probably some VCs that will see this as a good opportunity to get some nice deals done. But generally speaking, VCs don't care so much about getting a good deal or low prices. They only want to see, can this become a $1 billion company? And if it goes a little bit up and down in valuation in the beginning, that doesn't really matter to them. So it's a bit harder for those companies to raise now, I would say, for sure.
And for the general, another follow-up question, do you think that one pandemic will make it real difficult to raise funds in the first or second quarter of next year?
No, actually, there's quite a lot of funds that are still actively investing. So that's really good news. I think, good companies are still getting funded. Absolutely. It's just about, convincing the right investors and about a numbers game of reaching enough investors and going out broad. There's still rounds being done. And one positive thing to mention here is that there's never been so much capital in European VC. It's more than ever before. And VCs have a need to allocate their capital because it constantly is burning because they only have 10 years on their entire fund, and they have to make sure that they can invest that capital and exit that capital in that time frame. So there's definitely going to be deals being done.
Another question about the financial projections while showing if they don't have a revenue or pre-revenue, how to show financial projections. Or Alex also mentioned that when VCs ask for cash flow for a startup in seed rounds, there's not much to show. Should we also include financial projections? What do you think about the financial projections, especially pre-revenue rounds?
Yeah. So projections are super important, right? Because they are going to sit and calculate on their end if they believe what you're showing is doable, and not the least if it's doable, but how much it's going to cost to get you there. So they're gonna really dive into the headcount growth you're showing. And by the way, your revenues in typical B2B SaaS operational models should be driven by the headcount that you have of sales team. So every salesperson should have some kind of quota and some kind of haircut in the first 3 to 4 months where you reduce how much of their quota they can actually pull in, because it takes time to train and properly get a salesperson up and running. But you should create a believable forecast that also shows quick and strong growth. So without doubt, the forecasts are super important. But you have to make sure that the EBITDA deficit is believable. So the sum of all the negative EBITDAs that you need, that you have until the next fundraising round, that should be about the amount of money that you raise right now. So you sum all the negative EBITDAs, should be about whatever you're raising now. And that should be enough to carry you to 10, 12 to 18 months forward. Forecasting all that aspects is absolutely very important. The other piece that is very important here on pre-revenue is to show that you have a pipeline that if that pipeline converts the way you're thinking, the forecasts are absolutely doable. And so even though they're just numbers that you invented, tying it into your current interest and your pipeline of potential customers is important.
So, following on your answer, sometimes I see some slides, especially in startups pitch decks. They also project 5 years or 10 years. Is it real? Is it a good approach to show these kinds of projections?
It's completely meaningless. Typically I ask for 2 years. Like if it's a Series A stage company, I typically ask for month by month revenues, 2 years backwards, 2 years forwards. And any more than 2-3 years forward is kind of ridiculous and doesn't make a whole lot of sense. We like to see it month by month, especially within the 1 year back or 2 years back and 2 years forward, just so we can understand how if this is a B2B SaaS company with a subscription model, how the recurring revenue evolves. We want to see growth on a monthly level. I'm just going to say this out now because this is something that a lot of people make a mistake on. Most investors don't want to see your cash flow in this regard. You want to see the GAAP revenue. So if you have a 1 year subscription contract that's paid up front, that's worth 12,000 euros, it's supposed to show 1,000 euros in every month for the next 12 months, and then the continuing for every year into perpetuity, and not 12,000 in January and 0 in the rest of the months. So you smear it over the time that the service is delivered.
Very clear. Thank you very much for the clarification. Another question from Burak Birant. I mean, not another question, the first question from Burak. For an early stage startup incorporated in Istanbul and Amsterdam, they are incorporated in 2 cities. Is it possible to advise a raise seed round from both countries? Or should we go for one for the VC in one country? Thank you.
If there's multiple companies, the VC always invests in the parent company. So I'm not sure if I fully understood the question, but the VC only wants to see one clear company with one clear value proposition, one clear strategy, one clear growth plan, one clear product, and not multiple things. So that's quite important.
Mm-hmm. So I think it is very early. The parent company is in Amsterdam. So I think Burak asked that their parent company in Amsterdam and the Istanbul company is probably their team is here and they are paying here with the company. So he's asking about should we go to raise the funds for different countries?
You mean where the investors are from? I mean, it's much easier to raise where the actual management team is sitting. So, you know, often like if a UK company invests in a company that's not in the UK, sometimes they might ask if you're planning to expand to UK that the management team moves to the UK. So, so definitely, you know, a lot of funds have this requirement that they want to be within 4 hours travel from where the management team sits, just so they can, you know, work together with them to ensure a successful growth and exit. So yeah, but if there's I don't know what the reason is that there are many subsidiaries. The cleaner the cap table is, the easier it is to raise funding.
Ozan is also live.
Yeah. I was listening up, and I think the startups took a great advantage of having Magnus. I will need to actually gotta go, so I just want to say thank you, Magnus. It was great to see you again.
Likewise.
I'll be sending you a few things recently that's happening in the ecosystem here, and would like to catch up. And if you guys have the time to continue, please do so. It's been a pleasure. And for the teams that are listening, I'm sending a feedback form that to judge what I did last week. So I just wanted to jump in, send the feedback form, and hope to see you soon. Thank you, Burak. Hope to see the team soon as well.
Take care, Ozan.
Take care. Bye.
Burak, I actually have my next meeting, I see, in 2 minutes also. So very happy to sort of, you know, catch up with individual companies later. If anyone think that they are a match with what we do, very happy to take a look at them and see if we can help some way. And otherwise, Burak, thank you so much for having me again. Really appreciate it.
Magnus, thank you very much for your valuable time and have a great evening. Stay safe and healthy.
Thank you. Take care, guys. Likewise. Bye.